Hi, everybody, and welcome back to Chapter 21, our fourth video. And when we left off, we were looking at computing the overhead spending and efficiency variances. So if I go back to my previous slide, here is, I guess I went too far. Here we go. Our spending variance and efficiency variance, we're going to go do next, which are located here. All right, so how do we do that? We're going to look at the variable overhead variance. That was $650 favorable. And we did that by the numbers that we had in our exhibit 2116. And then our standard was based on 3,500 units. We used a half an hour per, and then we had $4 of our variable overhead rate per direct labor hour gave us $7,000. So we're $650 favorable. But our fixed overhead variance, we go back to exhibit 21.16 again, and we pick up the actual fixed overhead of 11,800 and compare it to our standard. And that's standard was based on the 3,500 actual units that we had, and we used a half an hour of direct labor times the $6 fixed overhead rate per direct labor hour. And that gave us a $1,300 fixed overhead variance. So if we expand our overhead variance formulas a little bit, then here is our actual variable overhead, here, actual, and here is our applied, and we're going to then calculate the spending variance and the efficiency variance and calculate the variable overhead variance, which we just did. And similarly, for the fixed overhead, we do the same thing, but we call that spending variance, just like we did for the variable side, but volume variance for the fixed overhead. So together, that represents our fixed overhead variances and our variable overhead variances. Okay. If you follow that the first time, you're better than I was when I went through it the first time. This is very complicated, and you need to really study this. Our variable overhead variance, now here we're looking at this, and we're breaking that down, and we're going to go grab 6,350 and 7,000, and we'll break that into its pieces. Our spending variance, that's going to be $450 favorable, and our efficiency variance is going to be $200 favorable. In total, we have a $650 favorable variable overhead variance. Okay, now if we look at the fixed overhead variance, we do the same thing. We grab those numbers here, here, and here, and calculate the spending variance, which is $200 favorable, and the volume variance, which is $1,500 unfavorable. Together, they represent $1,300 unfavorable fixed overhead variance. Okay. All right, prepare the journal entries for standard costs and account for the price and quantity variances. So here, we're going to look at recording the direct material costs. So our work in process inventory, we debit that because we're bringing that material into work in process inventory and out of raw materials inventory. Our actual cost in raw materials inventory was $37,000 $2,800. We brought it into work in process inventory at $35,000. So we have $2,800 of difference here, and we calculated that. Part of it was price variance, $1,800, and part of it was quantity variance, $1,000. And so that accounted for that difference. Now, I should point out that many companies record the material price variance when the materials are actually purchased. But for simplicity, we're going to record both materials price and quantity variances when the materials are actually issued from raw materials inventory into work in process inventory. Okay. All right. I think that's pretty straightforward. New, unfamiliar, but pretty straightforward nevertheless. Now, direct labor, we have the same kind of thing. We actually paid $56,100. So we're going to charge work in process inventory here for the standard cost of $56,000. And we had two kinds of variances. We had a rate variance, which was unfavorable, and an efficiency variance, which was favorable. So when we match those against this journal entry, the journal entries, debits and credits equal each other. Okay, so that accounts for the direct labor journal entry. Now, our overhead. Again, we're going to charge our actual factory overhead was $18,150, and that's what we applied, right? And $17,500 is what we applied. $1,750 at standard, $10 standard, and there she is. And we split that out between volume variance and controllable variance. Okay, so when factory overhead is applied to work in process or goods in process, the actual amount credited to factory is credited to the factory overhead account. Then to account for the difference between actual and standard overhead costs, the entry is going to include $500 debit to volume variance, $250 debit to variable overhead spending variance, and $100 credit to variable overhead efficiency variance. All right. I think you're going to need to look at that in a little more depth before you really have that well understood in your minds. Okay. That concludes chapter 21. As I say, I believe that's the most complex and difficult chapter in the book. I think if you study this carefully, all those uncertainties and difficulties, I think you can get past, but you do need to study this chapter. Anyway, that's all for this chapter, and when we come back, we'll talk about chapter 22. Until then, bye for now.